So the Fed is stuck between, on the one hand, a system that is wildly over indebted and is starting to crack under the pressure of all that debt. You and I have talked about commercial real estate and housing and lots of other parts of the system that are interest rate sensitive and that are overvalued, where no matter what it does, it's going to cause a crisis of one kind or another. And I think that's the story of the year ahead. The Fed has to choose. And when it chooses whether to ease or tighten,
the commercial real estate market in 2024 is undergoing a significant transformation. While rising vacancy rates and slowing rent growth continue to cast a shadow from the previous year, impacting all sectors, some areas are displaying remarkable resilience. Conversely, others are struggling under persistent headwinds. John Rubino points out the pressing concern of an excessively indebted system that's starting to reveal its fragility under the burden of its financial commitments. Sectors like commercial real estate and housing are especially at risk, given their susceptibility to fluctuations in interest rates and their inflated values. Furthermore, Rubino emphasizes that the Federal Reserve's choice between stimulating economic growth or reining in inflation will carry profound consequences. Activity in the office sector has continued to dwindle in the first quarter of the year. Vacancy rates have surged to almost 14%, hitting unprecedented levels. In contrast, the multifamily sector has enjoyed a revival, propelled by enduringly high mortgage rates. Meanwhile, attention on the national debt has intensified as the United States gears up for the November election. The debt now exceeds $34.5 trillion, equating to over $103,000 per person in the country. At the same time, the U.S. Central Bank has reiterated its decision to maintain unchanged interest rates, citing a lack of further progress in tackling inflation. According to John Rubino, the Federal Reserve is confronted with the question of whether it should ease policies to support vulnerable sectors or tighten them to tackle inflation. Regardless of the Fed's course of action, a crisis appears unavoidable. The upcoming year will likely hinge on the Fed's decision, dictating the nature of the impending crisis. Let's delve into the video to gain further insights.
Well, I think a soft landing is highly unlikely because we can't get inflation back down to the Fed's 2% target. And that's official inflation, which is really distorted by all the statistical games they play. So let's say that today's 3.5% official inflation is actually 5 or 6%. Well, that's a crisis. That's when you usually raise interest rates. So the Fed is stuck between, on the one hand, a system that is wildly over indebted and is starting to crack under the pressure of all that debt. You and I have talked about commercial real estate and housing and lots of other parts of the system that are interest rate sensitive and that are overvalued. So those things, they want to crack, they want to give us a deflationary crash. But at the same time, the Fed would normally lean against that with lower interest rates. So it's got inflation that it really ought to be tightening monetary policy to combat. And then it's got all these interest rate sensitive sectors that are cracking where the Fed should be easing to fix them. And so it's in this box where no matter what it does, it's going to cause a crisis of one kind or another. And I think that's the story of the year ahead. The Fed has to choose. And when it chooses whether to ease or tighten, then we'll know what kind of a crisis that we're going to get. But we're going to get a big crisis regardless because we've built up so much debt. And we've got asset prices at levels that always and everywhere precede a big crash. Stock prices have never been this expensive without a gigantic crash coming. Same thing with housing prices relative to incomes. Same thing with commercial real estate valuations relative to actual value. All of those things ought to lead to a big crash where everything is repriced. And so that's still out there waiting to happen. If interest rates are going to go up from here, which they have been lately, then that brings a crash in assets, in financial assets, that much closer. So I think there's a decent chance in the year ahead that we absolutely do not get a soft landing, but we get a very hard landing via the equity markets or via the real estate markets that then force the government to come in and bail everybody inside out. If commercial real estate blows up and that takes 3,000 local and regional banks with it, then it doesn't matter what inflation is. The Fed is going to step in with easy money to bail everybody in sight out to prevent the crash from metastasizing into a depression. So anyhow, that's the kind of stuff that we're looking at for the year or two ahead. And there doesn't seem to be any way of avoiding something like that. The details are unknowable. The timing is unknowable. But we've set up the conditions for something really serious to happen in the not too distant future.
U.S. inflation remains stubborn despite slowing late last year after 15 months of aggressive rate hikes that the Fed halted in July. Data showed that core U.S. personal consumption expenditures inflation rose 3.7% in the first quarter after growing 2% in the fourth. Younger generations encounter skyrocketing housing costs, pricey stocks, and excessively high college tuition fees. The student loan landscape in the United States is more daunting than ever, with over 43 million Americans grappling with a staggering $1.7 trillion in federal and private student loans. John Rubino explains that inflation impacts each generation differently. He blames the government for causing moral dilemmas by using inflation to serve political and military purposes. According to Rubino, these challenges arise from the government's decisions, such as devaluing currency to meet immediate objectives like winning elections or financing wars. Now, let's redirect our attention to a video.
Inflation affects different generations in different ways. If you're, the baby boomers in the 1980s and an inflation starts, when you buy your house, the house goes up in value for the next 30 years, your stocks go up, but you get to go to college when college is super cheap before the inflation kicks in. Later generations come along and they can't buy a house because houses have gone up too much. They can buy stocks, but stocks are super expensive and probably not that profitable. And college tuition has gone through the roof. So they can't go to college cheaply like we did as baby boomers. And so the government comes along with this program that says, you can still go to college and you'll make a ton of money if you just get that degree. So don't worry about it. We'll just lend you the money. That sounds an awful lot like what the credit card guys do. They allow you to borrow money for something that turns out to be of very dubious value and wildly overpriced. And then they demand that you pay back that money with no chance of even getting out of it via bankruptcy. You can't discharge student loan debt in bankruptcy. So, I think that on the one hand, if you borrow money, you ought to be morally obligated to pay it back, especially in the case of student loans, when you get something that you didn't have to choose, but you did choose, and something that was pretty expensive, but also pretty valuable. You shouldn't have to pay that back. On the other hand, the government via inflation, which nobody understood, the government kind of tricked you into doing that. So you've got these two, I think, equally valid points of view. And the overriding point is that the government is the thing that's at fault here, because inflation tricks people into borrowing money that they might not otherwise borrow because it looks like the value of what you're getting when you borrow and spend is higher than it actually is. I think that we're creating these kind of moral dilemmas because we're choosing to inflate away our currency in order to win elections and fight wars and things like that, which we probably shouldn't be doing in any event, And so I think it's a widespread moral dilemma. I think everybody has a point of view that's kind of valid. Your point of view is absolutely valid.
While 2024 is expected to be a better year for the housing market in many respects, a lot of buyers are still going to need help finding affordability. Now, the big question in the U.S. is whether or not interest rates will actually be increased rather than cut, a situation that seemed unthinkable just a few months ago. The U.S. economy and housing market are beginning to experience a massive slowdown. What happens next? Feel free to share your thoughts in the comments.